Hi and welcome to our video on the higher highs investment strategy. This is a combination of technical analysis and momentum investing where we're trying to find assets in a powerful uptrend and then ride that momentum wave. But how do we know an uptrend is real and not just a dead cat bounce? It can come down to price action, or a higher high occurs when a peak is in an asset price surpasses the previous peak. It isn't just a number on a screen, it's a psychological signal that the buyers are aggressive enough to push the price into new high territory. And to confirm a true trend, we look for three things. Higher highs, which is successive peaks that keep climbing, signaling bullish momentum. Higher lows. Every time a price dips, it stops at a level higher than the last trough. And this shows us that the floor of the stock price is also rising. And support and resistance levels. We want to see a price consistently breaking past old ceilings, which we call resistance, and then treating those old ceilings as new floors, which we call support. So some of these you can screen for, like new highs and some higher lows, and support and resistance we can use technical analysis for. As this is a momentum strategy, price action is key. So to ensure we have a solid upward trend, we use other indicators. First, we look at moving averages. For a healthy upward trend, the price should stay above the 50-day and 200-day moving average. If the price is consistently below these lines, a higher high might be the last high, meaning you will be buying at the top, which is obviously something we don't want to do. And we can screen for these through a standard screener out there. Next, we check the relative strength index, the RSI. This tells us if the asset is getting overheated. So we want a strong momentum, but we generally look for an RSI below 70. If the RSI is at, say, 85, the asset is called overbought, meaning that we've sort of missed the boat on this rising momentum. And an RSI below 70 tells us that there's still a bit of room to run in momentum. And the great thing about investing is that there's always another opportunity around the corner. So if you have missed the boat, don't go chasing it, just let it go and move on. So now let's talk about execution. So we don't want to just buy because the trend is up. We want to wait ideally for a breakout. So you want to see the price clear the previous high on strong volume. And high volume acts as a sort of fuel that confirms big institutional players are buying along with you. So in an example, if an asset, if their last high was €100 and it breaks to 105 on heavy volume, that's your entry signal. Now you could determine all these and the volume levels by looking at the charts, and you'll be able to see what the volume is relative to previous volumes. So you'll be able to identify whether it is heavy volume or not. But what if you're wrong? This is where we have our risk management come into play. So we can place our stop loss orders just below the most recent higher low that you can see on the chart here. And if your entry was 105 and your previous low was 95, you might set your stop loss at about 94, somewhere just below 95. And this protects your capital if the trend suddenly snaps and turns the opposite direction. So when do you sell? Well, you hold as long as the pattern holds, but the moment you see the lower high or the price break below the key support level, the trend is likely over at that point, and that is your cue to exit the trade. Now let's look at a quick case study of our example here, ABC Corporation. So the stock climbed from a high of €50 to 55 and eventually to 60. And during those same pullbacks, the lows rose from 45 to 50 and then €55. So following our plan, we buy when it clears €60 and set our stop at 55 and simply hold as long as those keep climbing. So we can compare this to a lower low market, which is bearish, and in a downtrend you see a successive price lows decreasing. And that's an environment for shorting or simply staying on the sidelines. So the takeaways here are to spot the pattern and look for the higher highs all the time, and confirm this by using moving averages and an RSI. And then we enter on a breakout where we buy the strength and don't guess the bottom, so we can see where the breakout happens and we can enter at that point. And then once we're in the trade, the key is to manage the trade and manage your risk while you're in there. So you set a stop loss in order to manage that, so you can then sleep at night knowing that if the thing suddenly breaks out and the trend stops, then you'll be cut out of the position automatically. So this strategy is simple, effective, and it works across almost any asset class. So it keeps you aligned to the market momentum rather than fighting against it. So if you're not so keen on technical analysis and reading charts, basically what an alternative to this, which we've tried, is not sticking to the purest version of higher high strategy, but really just taking a screener point of view on trying to select your stocks. And then instead of picking one stock, you pick a range of stocks and you invest based on those as your portfolio. So really what we do here is we get our screener and we screen for higher highs, we screen for an RSI that's not overbought, and we screen where the moving averages, the shorter moving averages are above the longer moving averages, be they price 50-day or 200-day, that the shorter 50 is above, the price is above 50 and 50 is above 200. And that confirms the momentum, that confirms that it's not overbought, and that confirms stocks that are already hitting higher highs. So that will give you a selection of stocks that you can either individually look through and see how the technical analysis says about supports, resistance, breakouts, and so on, or you can simply select those based on maybe market cap or something if you want to pick solid stocks, and just invest in those and set your stop losses based on that.